Good afternoon. Welcome to the American Enterprise Institute and today's event, Market Rules, a discussion with Professor Mark Rose. My name is Paul Kupiec, and I'm a resident AEI scholar specializing in financial services. The structure of the American banking system, a handful of large supermarket institutions and thousands of smaller community banks, is the result of more than a century of political deal-making. In the early 1930s, FDR's New Deal reforms included the Glass-Steagall Act, a law that created federal deposit insurance and for more than 50 years separated commercial banks from investment banking activities. Federal deposit insurance, government controls on deposit interest rates, and protection from competition made the period from the mid-1930s through the 1950s among the best of times for small community banks. Still, underlying market forces favored the formation of large regional banking groups. Innovative holding companies like the Transamerica Corporation invented legal ways to assemble large interstate banking conglomerates, potentially creating a new source of competitive pressure for small-town banks. Community bankers' fears only deepened when the Federal Reserve Board lost its 1948 lawsuit to try to break up Transamerica, charging that Transamerica had violated the Clayton Antitrust Act. But the Fed has never remained stymied by the limitations of law passed by Congress, and so the Fed and its supporters set out to change the law. In 1956, Congress gave the Federal Reserve power to dampen the threat of interstate bank competition by passing the Bank Holding Company Act. Circa 1960, the U.S. had nearly 13,000 independent banks, the largest 10 of which held about 22% of all U.S. deposits. But in the early 1960s, the banking business began to change. Change was slow at first, but the pace accelerated in the 1970s, 80s, and 90s. Today, the banking industry looks a lot different than it did in 1960. There are far fewer small community banks and a relative handful of very large institutions that own commercial banks, investment banks, and other financial operations, so-called supermarket financial institutions. At the end of 2018, there were less than 4,700 banks in the U.S., and as of December 2017, Forbes calculated that the 5 largest banks held almost 42% of all U.S. deposits. So the system had gotten much more concentrated. In his new book, Market Rules, Professor Mark Rose tells the story of the politics that pushed the financial sector to transition from its splintered composition in 1960 to the structure it has today. Mark highlights changes that were only made possible through the efforts of influential politicians, bankers, and government banking agency officials. A recurring theme in the story is that the transition was no easy task. The road to financial sector modernization had to overcome the protectionist interests of community bankers, insurance agents, and the lingering progressive era suspicion that concentration in banking favored the coastal elites at the expense of mainstream America. Things you still hear today, I think. With that short introduction, let me explain the plan for today's events. First, we'll ask Professor Rose to give us a brief tour of his new book, Market Rules. Next, we have 2 noted experts who have read Mark's book and will share their views with us. Speaking first among the noted experts will be Richard Silla, the Henry Kaufman Professor of History and Financial Institutions and Markets at New York University, Stern School of Business. And next, we will have R Street's distinguished senior fellow, Alex Pollock, to share his views. Following that, I will moderate a discussion with today's speakers and then entertain questions from the audience. Now, I'm pleased to introduce this afternoon's guest author. Mark Rose is a professor of history at Florida Atlantic University. He's the author of more than 40 academic articles in history-related journals and several books. He's the co-editor of the book series American Business, Politics, and Society, published by the University of Pennsylvania Press, and an active member of several professional associations and journal editorial boards. And with that short introduction, please join me in welcoming Professor Mark Rose.
Thank you, Paul, for that nice introduction. Thank you all for coming over here. I appreciate the opportunity to talk a little bit about the book. Rather than trying to provide an overview, what I chose to do was to talk about Jeb Hensarling, who spoke here in 2017, and it's the conclusion of the book, and I think it ties together, it provides an opportunity to link together a number of my themes. In July of 2010, President Barack Obama signed the Dodd-Frank Act. The act ran more than 840 pages in length. Obama and congressional authors also left parts of bank regulation unfinished. To complete Dodd-Frank, lawmakers directed the Comptroller's Office, the Federal Reserve, and other bank regulatory agencies to prepare nearly 400 detailed rules. Rulemaking was not the stuff of newspaper headlines and lead stories on TV news. At quick glance, topics like appropriate measures of a bank's capital adequacy or the leadership of the Consumer Financial Protection Bureau would never enlist and hold a large audience. Yet, the Dodd-Frank Act still fostered passion. The bank crisis of 2008 and the job losses and home foreclosures that followed remained vital topics for lawmakers and elicited painful memories for millions of Americans that extended into the next decade. All of a sudden, the dull process of Dodd-Frank rulemaking opened another opportunity for regulators and lawmakers to restrain bankers' speculation, argue for more bank lending, and offer community bankers a hand up against the supermarket banks. The mind-numbing business of writing bank rules carried practical consequences for bankers, lawmakers' careers, regulators' authority, and bank customers that did not require a lengthy explanation to anyone involved in the process. I seek to advance 3 points this evening. First, disputes about bank legislation and regulation enjoyed a lengthy history in American politics. Starting with John Kennedy in 1961 and extending to Donald Trump, every president of the United States promoted legislation and regulations intended to foster creation of large banks. I characterize these banks as supermarkets because they provided a variety of financial services in one place. Dodd-Frank's authors, including Treasury Secretary Timothy Geithner, had sought to head off the next bank crisis and to maintain supermarket banks at the center of the American financial economy. My second point is that new bank legislation and regulation always encouraged strenuous opposition. Between 2010 and 2017, as this evening's example, Representative Thomas Jeb Hensarling led a growing opposition to the Dodd-Frank Act. Hensarling's ideas held out the possibility that community bankers would once again achieve a privileged place in banking's hierarchy, reversing decades of decline at the hands of lawmakers and supermarket bankers. In this volatile setting, the Volcker Rule, which limited bankers' ability to trade with their firm's money, was tailor-made for Hensarling and other Dodd-Frank critics during Obama's presidency. And my third point is that supermarket bank advocates and opponents identified markets as their goal. I characterize their rhetoric as market talk. Jeb Hensarling proved especially skillful at constructing that talk. Two experiences informed Hensarling's politics. First, Hensarling grew up in a household suffused with anti-government rhetoric. In 1964, when Hensarling was 7 years old, his parents supported Barry Goldwater for president. Goldwater championed ideas such as diminished federal spending and a sharp reduction in the number of federal rules. Hensarling's mother cried when Goldwater lost, he reported. Hensarling credited Senator and Professor Phil Gramm with having exerted the deepest influence on his anti-state thinking. As a student in Graham's courses, Hensarling told a writer in 2009, I suddenly saw how free market economics provided the maximum good for the maximum number. Graham was also the author of a second theme that informed the young Hensarling. Graham, according to Hensarling, demonstrated the meaning of being a Republican. Hensarling never defined that term for journalists. or his fellow lawmakers. Most likely, it had to do with Hensarling's acquisition of Graham's well-honed ability to translate marketplace abstractions into pithy sayings about pocketbook issues. Starting in 2003, Hensarling took these ideas about government and the economy to the U.S. House. Hensarling, as before, advocated for a federal government that was smaller, less intrusive, and less costly. Not even Lehman's 2008 bankruptcy and the unraveling of the nation's financial arrangements moved Hensarling to change his mind about government spending. In October 2008, he voted against the $700 billion TARP bill, refusing the urgings of President Bush and congressional leaders from both parties. Starting in 2009, Hensarling adopted the Tea Party's anti-TARP views. The TARP program of cash injections and loans to banks amounted to, he said, the opposite of the dynamic of entrepreneurial capitalism. The Obama administration and congressional Democrats, Hensarling added, used TARP funds to advance their social and political agenda. Hensarling expressed fear regarding what they are attempting to do to my country. Obama and Democrats, Hensarling judged, fostered suspect undertakings. In June, with Tea Party activists enjoying greater prominence and clout among Republicans, Hensarling introduced legislation to terminate the TARP program by year's end. Obama and House Democrats would never approve such a dramatic change, Hensarling recognized. In November 2009, a popular writer characterized Hensarling as the GOP's most powerful nobody. Around that time, Hensarling committed to a long-term strategy of delegitimizing and repealing Obama's major legislation. The Dodd-Frank Act and the Volcker Rule resided at the top of his list. In 2014, Republicans held the majority of House seats, and Hensarling assumed the chair of the Committee on Financial Services. Angry Tea Party voters and slow-moving economic recovery contributed to Republicans' electoral success. In January, Hensarling held hearings titled The Impact of the Volcker Rule on Job Creators. Again, the Volcker Rule capped bankers' proprietary trading at 3% of capital. Many or most Americans still lacked familiarity with its limitations. As well, members of the House committee could not simply repeal a rule. Instead, Hensarling used hearings to focus journalists' and supporters' attention on government regulations that hit Main Street and, regrettably, the poor and downtrodden among us. MIT professor Simon Johnson also testified at the hearing. Johnson's sober concerns about systemic risk and how regulatory agencies will work together could never match Hensarling's more quotable assertion that the Volcker Rule would take $800 billion out of the economy. Hensarling was canny in his ability to link remote federal regulations to constituents' anger about federal bailouts and an overriding interest in maintaining both hands on a wobbly economic and social ladder. During 2016, as the presidential election drew near, Hensarling relied on his sharp wit to skewer bank regulators and their regulations. In mid-March, American Banking Association leaders held a summit in Washington, D.C. The Dodd-Frank Act, Hensarling told audience members, should be called the Obama Financial Control Law. By whatever name, the legislation imposed incomprehensible complexity and more government control. Working families, Hensarling warned his listeners, have seen their paychecks shrink by more than $1,600. Hensarling was equally adept at linking obscure bank regulations to the growing perception among voters that the federal government awarded favors to the undeserving and failed to help decent Americans like them. In that talk to the Bankers Summit, Hensarling brought a special message to heads of smaller banks. Washington's regulatory waterboarding is drowning community banks and small businesses, he asserted. I will not rest until Dodd-Frank is ripped out by its roots and tossed on the junk heap of history. Hensarling assured audience members. Those listeners always attuned to any committee chair's views, would have heard and read toned-down versions of these remarks many times. But now, as the next election approached, Hensarling needed to build enthusiasm among bankers and other likely supporters. Hensarling's remarks comprised one of the ritualized features of recruiting and motivating heads of large and small banks in advance of major legislative effort like repealing Dodd-Frank. Republicans still had to elect the next president. In June 2016, Hensarling met with Donald Trump, the Republican Party's certain nominee. Trump and Hensarling spoke at Trump Tower, where they discovered a common and deep animosity toward Dodd-Frank. In campaign stops and interviews, Trump had made the Dodd-Frank's many rules a regular target. In January of 2016, interviewed on Fox TV, he described Dodd-Frank as a disaster in so many different ways. The nation's banks were totally regulated to a point where no banker is controlling their own bank. The net result of these regulations, Trump asserted, was that bankers had stopped making loans to small business people. In October, at a campaign stop in Charlotte, Trump also blamed Democratic nominee Hillary Clinton for lifting Glass-Steagall and pushing subprime lending, an act that in turn had brought us the financial recession. More accurately, Hillary Clinton's husband, President Bill Clinton, had promoted passage of the Gramm-Leach-Bliley Act in 1999. Perhaps Trump did not realize, or did not care, that Hensarling's mentor, Phil Gramm, played a key part with President Clinton in the act of ushering supermarket banks to legal completion. Nor did Trump seem to recognize that Gramm-Leach-Bliley's complex rules had played little or no role in bringing about the financial crisis of 2008. In great measure, however, Trump sounded like Hensarling, who since 2010 had decried regulations that reportedly harmed banker and borrower alike. Hensarling did not offer an immediate embrace of Trump's candidacy, but Dodd-Frank certainly presented them with a common legislative enemy. Here's something we both agree with, Hensarling told a TV audience after the meeting. The Dodd-Frank Act fostered poverty, contributed to middle-income people remaining trapped, and its mind-numbing regulations kept capital on the sidelines. Every president, starting with Ford, had made similar points about the federal government's countless rules and their supposed connection to slowed growth. Phil Gramm had advanced his career in Congress based on an identical argument. Opposition to the federal government and its rules that derailed the market's automatic and beneficent workings enjoyed a lengthy history in American political maneuvering. In this latest iteration, Hensarling brought fresh zeal and keen rhetorical skills to the formidable tasks of eliminating the Volcker Rule and the Dodd-Frank Act. In September 2016, Hensarling filed his Financial Choice Act. That title evoked an image of sovereign consumers who conducted business with financial supermarkets that would, at long last, operate with fewer legal and institutional constraints. In truth, Hensarling's proposed legislation included phrases like risk-weighted assets that only financial specialists would understand. Hensarling asked for the moon in Dodd-Frank, a writer for American Banker determined. Naturally, Hensarling aimed to eliminate the Volcker Rule and to increase congressional oversight of the Federal Reserve, the Comptroller, and the Consumer Financial Protection Bureau, another group of favorite Republican targets. It's time for economic growth for all, bank bailouts for none, Hensarling announced in one of his crisp talking points. With the hyperbole of campaign season at full throttle, no one apparently asked Hensarling or Trump how the Dodd-Frank Act had foisted so many nefarious outcomes at one time onto American business, or how Hensarling's equally complex Financial Choice Act would relieve those evils. Unlike Trump, however, Hensarling was articulate, rhetorically disciplined, and always insistent about the economic benefits certain to follow when market-oriented bankers replaced federal regulators in the allocation of capital. On November 8, 2016, Donald Trump was elected president. That same month, a Fortune writer described Hensarling as Washington's newest power player. For a day or two, journalists reported that Trump's top officials were considering Hensarling for the post of Treasury Secretary. Trump's aides, according to a news report, liked Hensarling's free market background and deep GOP ties. Hensarling and Trump were allies and competitors in the business of denouncing the Dodd-Frank Act and the Volcker Rule and promising faster economic growth. Trump, however, introduced subtle changes in his approach to bank politics. First, Jamie Dimon emerged as the president's banker, an informal position held in the past by executives such as Citibank's Walter Wriston and Nations Bank Hugh McColl. Starting in the 1980s, Dimon had served as a top officer in Sandy Weill's worldwide financial empire and then as president of the gigantic J.P. Morgan Chase. In 2017, Dimon was the only top executive who remained active from the era when building supermarket banks was in vogue. Nothing in Dimon's background and contemporary responsibilities suggested anything as dramatic as a vast remodeling of the rules that framed the American financial architecture. Bankers, including Dimon, had already spent billions to adapt their operations to conform to Dodd-Frank's rules. Rather than the abolition or radical diminution of regulation, heads of the largest banks, such as Dimon and Bank of America's CEO Brian Moynihan, sought to bring European and U.S. bank rules into closer alignment on questions such as how to measure capital adequacy. Trump's second change regarding bank politics was still more understated. Trump appointed Gary Cohn to head the National Economic Council. In 1993, President Clinton had created that post and appointed Robert Rubin to head it. Like Rubin, Cohn was a former top official at Goldman Sachs, where he directed financial operations around the world. Given their backgrounds and Trump's priorities, Cohn planned to modify regulations in a way that increased lending and maintained the dominance of the largest U.S. banks in the world financial system. The United States has a huge competitive advantage, Cohn told a TV interviewer on February 3rd, and we want to preserve that advantage. Years before, Alan Greenspan and Robert Rubin had also sought to maintain that international advantage. The idea of American banks as major players in the world economy dominated financial policy makers' agendas in every administration from Reagan to Trump. By mid-February 2017, only a month after Trump's inauguration, longtime observers of bank politics dismissed Hensarling's and Trump's prospects for eliminating the Dodd-Frank Act. Those observers used terms like long, hard slog to describe the substantial effort that any president and Treasury Secretary would face in seeking a large overhaul of bank legislation. Dodd-Frank's tentacles go deep and won't be easily cut, a writer for an insurance-oriented publication noted that month. The supermarket bank continued to reside at the center of a presidential project more than 5 decades old. And yet, if any one lesson emerges from supermarket bankers' halting ascent in American politics, it was that no outcome was certain or inevitable. The organization of American banking and the markets that they made remained a matter of grinding politics. History governed its banking institutions, but few recognized its presence in their daily lives. Disconnection was part of the American style of politics, except when it was time to apportion blame or gain an advantage. Hensarling's moment to gain that advantage was evanescent. On May 23, 2017, for half an hour or so, bank politics achieved a momentary linkage between past and present. Jeb Hensarling sat here in this room for an interview. The AAI's Peter Walson conducted that conversation. Between 1981 and 1985, Wallison had served as general counsel to the Treasury Department. In that position, he advised Treasury Secretary Donald Regan about legal and legislative strategies to win congressional authorization to create supermarket banks. Wallison and Reagan failed to bring most of those plans to fruition. Hensarling and Wallison, as everyone in the room probably recognized, represented two generations of federal officials who had dedicated their professional lives to the idea that reduced taxes and fewer bank rules would inevitably hasten the pace of economic growth. During the interview, Hensarling lamented the weight, volume, and complexity of the Dodd-Frank regulatory burden. During President Obama's time in office, that joyous day when bankers experienced fewer rules would reside in the future. With Trump in the White House and majorities in both houses, Hensarling had a window to pass the Financial Choice Act. Market talk was the language Hensarling used to build a legislative coalition. Starting in 2010, Hensarling's job, as he defined it, had been to mobilize bankers and fellow lawmakers behind the effort to eliminate the detested Dodd-Frank Act and its vulgar rule. Hensarling's appearance at the AAI was another stop in that lengthy effort. Hensarling, and as audience members expected, referred often to the market's dynamism and transformative powers. Freedom was one of Hensarling's favorite concepts, and market discipline was another. That market discipline, Hensarling reported, prevents me from having to pay $50 for a hamburger instead of $5. Years in office had not diminished Hensarling's skill at articulating well-rehearsed, down-home phrases that suggested the uselessness of most government programs. In Hensarling's capable hands, market talk always found a ready audience among contemporary Americans. Senator Graham, Hensarling's mentor, achieved national recognition and a modest national following with that same rhetorical skill. Phil Gramm, President Ronald Reagan, and Citicorp President Walter Wriston had an invisible presence in front of the camera and microphone that morning. Hensarling liked the idea of a nation built around markets, at least in the abstract. As a seasoned legislator, however, he treated market talk as a device to gain tangible legislative goals, emulating Graham. Hensarling did not seek to eliminate financial rules, but to rewrite them in a way that favored small and regional banks and credit unions. Hensarling also sought to rein in the Federal Reserve Bank Supervision Authority. It was an open question, Hensarling told his AEI audience, whether the Federal Reserve ought to have a role in prudential regulation. During the years between the 1930s and the 1970s, Representative Wright Patman had also denounced Federal Reserve policies as part of a passionate commitment to protecting the markets of his small-town bankers. Market talk was about practical politics. During the long run-up to Graham-Leach-Bliley in 1999, market talk, at least among most bankers, comptrollers, and each president, was never about eliminating government, but about creating a legal and politically safe for supermarket banks offering new financial products. Those big banks would take their place alongside the Tennessee Valley Authority, the Interstate Highway Program, the GI Bill, and the Space Program as government programs that fostered technological innovation and added directly to productivity increases, more jobs, and wage growth. Programs like interstate construction were large, expensive, and difficult to bring into being, but the economic payoffs were vast. Bank politics promised a way out of expensive and politically exhausting government projects. Bank politics, equally tangled and jumbled, consisted of an effort by members of competing coalitions, assembled in each decade, to use the federal government to create an unseen, automatic path toward rising prosperity. No one's taxes had to be increased. No new bureaucracy would have to supervise this growth, and no group of federal bureaucrats would make determinations about interest rates and what disgusted critics like Graham and Hensarling described as the political allocation of loans, as, for instance, the Community Reinvestment Act. Prosperity through changes in bank rules promised a political economy that would eliminate the need for political economy. Market talk also blinded participants to one of the reasons they rarely succeeded in changing bank rules. Sovereign markets were fair and rational in allocating resources, or so ran the reasoning. But American institutions were not built and managed by economists or by market talk. Exactly who would prosper and whose business model, lifestyle, region, occupation, and hard-earned prestige made to falter was one of the perennial questions that got in the way of promulgating the next set of bank rules and the prosperity to follow. The markets that government made, including bankers' markets, governed American life in ways large and small, but also in unseen ways. That lack of visibility contributed to the idea that markets rather than government mattered. Bank politics was an exercise in economic acceleration through private firms rather than through another federal department and program. Here was an idea around which bankers like Sandy Weill and Hugh McColl and presidents as different as Lyndon Johnson, Bill Clinton, and Donald Trump could rally. And perhaps as productivity increases slowed in the 1970s and as partisan divides widened in the 1980s, bank politics remained among the handful of areas where presidents, comptrollers, and bankers stood a running chance at fostering prosperity. Not everyone had signed on to this half-century-long experiment in government-guided prosperity through the financial sector. Paul Volcker was not present at the AEI that May morning for Hensarling's remarks. Volcker was as voluble as Hensarling. Maybe it was just as well he chose not to attend. In December 2009, months before Congress approved the Dodd-Frank Act, Volcker spoke to economists, financial executives, and lawmakers, including the British Prime Minister and Treasury Secretary Geithner. This distinguished group had gathered for the Wall Street Journal Future of Finance initiative held in the United Kingdom. The commercial bank remained at the center of the American economy, he reminded the audience members. Otherwise, Volcker judged that financial innovations like the insurance that AIG provided for asset-backed securities had brought us right to the brink of disaster. In contrast, Volcker told surely astonished audience members, the most important financial innovation I have seen the past 20 years is the automatic teller machine. Historians, myself included, urge our students and fellow citizens to avoid speculation about paths not taken. But Volcker's admonition reminds us about the choices regarding the organization of markets that bankers and federal officials have made. Thank you for your attention. I look forward to the comments and then to your questions. Thank you very much.
I got the wrong chair. Sorry, Alex.
That's okay. I would have switched with you.
So thank you, Mark. Today we're honored to have two experts in banking and politics, banking history and politics. Speaking first will be Richard Silla, the Henry Kaufman Professor of History and Financial Institutions and Markets at New York University, Stern School of Business. Dick's research, which is extensive, is focused on the history of money, banking, and finance. He's the author of many well-known books, including A History of Interest Rates. His writings appear in numerous scholarly journals. He served as the president of the Economic History Association and the Business History Conference, and he's currently chairman of the Museum of American Finance in New York City. Dick?
Okay, thanks, Paul. Let's see, there's supposed to be a... Oh, there we are. They changed the date for me. This was supposed to take place about a month ago, but there was a snowstorm in Washington, and none of us could get here. My copy of this says February 20th. But okay, so we're talking about a book here, and I wanted to say some things about the book that. What's missing, what might have been in the book and it's not there. And so I wanted to, in the short time available to me, to talk a little bit about that and also one of the things that's missing is a lot of numbers. I'm an economist, Mark's a historian. By the way, we're very good friends for a couple of decades, so economists and historians can get along all right, right? So economists like data, and you won't find a lot of data in the book. There's a huge change in American banking. That's what the book is about. It's taken place over 5 or 6 decades, but Mark talks about the political economy of it, but you don't really see many data on it. The other thing I think is missing is this is a problem that I think a lot of American historians have, is that they just look at the United States. And so I think it's the international dimension of changes in banking that is, you won't learn a lot about that in Mark's book. And so those are the 2 things I wanted to talk about today in the time available to me. Here's some data on just the number of banks and the total assets of banks in the United States from roughly 100 years ago, actually 98 years, 2019 now, and the peak number of banks was in 1921, 98 years ago. I've studied 200 years of American banking history, and from 3 banks in 1790, all of which had been created in the previous decade, one in New York, the Bank of New York, one in Boston called the Massachusetts Bank, and one in Philadelphia called the Bank of North America. There were 3 in 1790, and by 1921, we had, in this country, 30,000 plus banks. 30,000 plus banks. It must have been like banking was like a Starbucks. You were never very far from a bank. Today you're not very far from a Starbucks usually. And of course the assets were in billions, and there's been a lot of inflation since then. So the assets won't mean very much. But and then you see, the 1920s, the so-called Roaring Twenties, actually reduced that number quite a bit. From 30,000 to 25,000. And I think, but nobody really thought, that's a lot of banks to lose. I mean, that 5,000 banks is about what we have now, and that's how many we lost in the 1920s. What happened in that decade is a lot of these little banks, and especially out in the agricultural areas of the country, they were little tiny banks, and despite the prosperity of the 20s, it wasn't so prosperous for farmers, and a lot of these banks had lent money to farmers, and the farmers didn't pay them back, so the banks disappeared. So that was a change, a drop in the number of banks. And so it's not the first time, but the drop in the number of banks that's happened in the period, roughly the last 6 or 7 decades that Mark talks about, that was nothing new in American history. It happened before. Then an interesting thing happened. If you look, the Depression, of course, we lost not 5,000, but, closer to 10,000, but 9,000, I guess we would say, in the 1929-1933 period. And a lot of us are familiar with that, so we don't have to talk about what happened in the 1929 to 33. But then an interesting thing, from 1933 to 1980, there was hardly any change in the number of banks. And that was a very heavily regulated system. Part of the New Deal financial reforms kept banking pretty much the same. And that's a pretty long period, and almost nearly half a century of hardly any change in the number of banks. That's when banking, and Alex and I would tell you, Alex wrote about this recently, banking was cartelized. Basically, it was a New Deal cartel. The shocking number of bank failures led people in 1933 to say, we don't ever want banks to fail again. Well, how can we keep banks from failing again? Well, let's just, not have very many banks and not much banking competition. Interest rates were regulated, entry into banking was regulated, and it was basically to keep the banking safe. And so that was, much of my life early part of my life was spent in that period. And there wasn't, when I began to study banking history, it was kind of interesting that the number of banks hadn't changed for 30 or 40 years. And when I probed into it, I discovered that entry was controlled, and the idea was not to let banks fail, to keep them very safe. 363 banking, people in the crowd have heard of that, haven't they? I mean, banking was so safe and overly regulated then that you said a banker he practiced 363 banking. You borrowed at 3%, you lent the money at 6%, and you were out on the golf course at 3 p.m. to have your round of golf. That's called 363 banking. That's what we had for 47 years. And then, of course, the big drop in banking since 1980. 1980 wasn't so different from 1933, but now we have a big drop to 4,800 banks, or if you count the savings and loans, you get a little over 5,000. So that's what Mark's book is about, but you won't find numbers like that in Mark's book. He's basically explaining how we got supermarket. And the next slide is on concentration. The concentration, which worries some people. Paul said I was the Henry Kaufman professor. I'm actually emeritus now. You mentioned that I'm emeritus, out to pasture, so to speak. The Henry Kaufman worries a lot. Henry's a good friend of mine, and he worries a lot about the concentration in American banking. And so you see the numbers here in 2018, 9 banks, the ones that have assets greater than $250 billion, had total assets of $8.8 trillion, and then the next 115 largest banks have assets of $10 to $250 billion. They have $5.4 trillion. So they have, if you look at the total assets on the previous slide, which I'll tell you, I won't go backwards, the total assets were $16.5 trillion, and you see that these 9 and 124 large banks have the lion's share of those assets. So we live in a very concentrated banking system compared to what we once were. And the last bullet point there, the FDIC, which rides herd on these, talks about 5,000 community banks, and they include commercial banks and savings institutions. They have $2.2 trillion. All of them together are smaller than J.P. Morgan Chase, all of the 5,000 community banks. And they have 1/8 of the assets of the banking system. So we have a very concentrated banking system now. But you won't see a lot of those numbers in Mark's book because he's dealing with the politics of banking more than the structural data of it. My last slide is about financial globalization. There's not a lot in the book about financial globalization. I think it probably was fairly important in what happened. As the points say, the U.S. banks expanded overseas a lot at the beginning of Mark's period in the 1960s and 1970s. They expanded overseas. Commercial banks and then the investment banks followed them. And when they went overseas, they discovered that banks in other countries had a different banking model. In particular, when they went into the continent of Europe, they discovered a universal banking model. Deutsche Bank, sometimes in the headlines today, was considered a sort of model bank back in those days, and Deutsche Bank could do all kinds of things American banks couldn't do. They could sell you insurance, they could manage your stock portfolio for you, they could, they were universal banking, what Mark calls supermarket banks. The universal banking model of Europe was one where banks had a lot of freedom to do the things that American banks gained, and Mark tells that story very well. American banks got the freedom, let's say, to be like Deutsche Bank. And when they were competing with Deutsche Bank in Europe, they might have gotten that idea that maybe we could relax our banking rules a little bit more in America. Another point about that is called financial department stores. That was popular. I remember when I first went to Stern in 1990, we had a lot of programs about, should the United States have universal banking? And my colleagues would, analyze that and come up with the notion that they should. Now I think maybe Sandy Weil was financing some of their research. So they began to lobby for, and eventually they received similar banking privileges and regulatory relaxations at home. So, there was always an argument. I mean, I don't think there's anything terribly sinister. Mark doesn't make it seem sinister about the concentration that's happened. I think my friend Henry Kaufman would think it was much more sinister than you do, but you tell us how it happened. But there was an argument for what happened, and that's that American banks, because of our banking history, they couldn't do things that other countries where you could bank nationwide. In America, really, until then, I was surprised when I started studying banking history that in the 1960s, you had to bank within one state. If you were lucky, you could bank within a state. Like in North Carolina and California, you could have statewide branch banking. But in many states, you were restricted to maybe the city you were located in or the city in the surrounding area. That was true of New York City. You could bank a bank in New York City. They were the biggest banks in the country, typically. Some of them were. They could only bank in New York City or maybe the surrounding counties. And then in my home state of Illinois, they were really enlightened. A bank had to operate out of only one office. So some of the big banks, First National Bank of Chicago, for example, had to operate out of one office in Chicago. We called this unit banking. And what did this mean, these restrictions on American banking? What they meant was that American corporations, Pillsbury could make flour in Minnesota and sell it all over the country. General Motors could make cars in Detroit and sell them all over the country. But the big banks couldn't do that. And I think American corporations, especially some of the ones that went overseas, were saying, we're going to have to deal with Deutsche Bank because these American banks can't, do all the things that Deutsche Bank can do for us. And so that little bit of that international story might have come in to explain why we got the banking system we did. And I will stop with that and turn it over to Alex, and I have to pass him the baton.
Thanks.
Relay race here.
Our
There's
next
your baton. Run fast,
Our next
Alex.
discussant is Alex J. Pollock, a distinguished senior fellow at the R Street Institute. Formerly, he was my colleague here at AEI from 2004 to 2015. And before that, he was the president and CEO of the Federal Home Loan Bank of Chicago from 1991 to 2004. Alex works on a lot of financial issues, business cycles, risk and uncertainty, housing finance, banking systems, and the interaction of all of these things with politics. He's the author of several books and numerous congressional testimonies, shorter articles and opinion pieces. I'm sure you've run across pieces by him in various financial publications. He's a graduate of Williams College, the University of Chicago, and Princeton. And Alex, the floor is yours.
Thank you very much, Paul, and delightful to be here. As somebody who has spent 5 decades either working in or thinking about the banking trade, and although I'm not a fan of the Dodd-Frank Act, and like Jeb Hensarling, I am a fan of markets, I really enjoyed reading this book. It makes one consider the banking trends over long periods of time, which are quite intriguing, I think. The hotly debated issues of past days, which we can now hardly remember how hotly they were debated, and presents a lot of colorful personalities, all of which largely overlapped with my own career. From the very beginning of my own days as an international department trainee in the great international expansion of the American banks, Dick, I've always found the banking system intellectually interesting. And one of the most interesting things about it is indeed the constant interaction with governments and between governments and banks, and therefore between banks and politics, exactly what Mark writes about, I think, in quite an interesting way. As this is going on, governments try to use banks for their purposes, for the government's purposes, and banks simultaneously try to use governments for their purposes, and both succeed to some extent, although both find themselves linked together from time to time in financial busts, crises, and bailouts. In other words, banking is always political finance. The book uses the term political economy. I think of it as political finance. As one British observer has correctly written, the government's involvement in banking is so immense that it's difficult to see clearly where the private sector world begins and the imprint of the state's authority ends. Market Rules, our book, demonstrates the truth of this observation in the U.S. since the 1960s. But I believe the observation is also true, and Dick mentioned an international perspective. I think this is also true in all times, going back at least to the creation of the Bank of England in 1694 as a mutually profitable deal between King William's government, which had wars to fight and to finance, and the enterprising bankers of the day who propped up the idea of the Bank of England. In general, as banking scholar Charlie Calamaris tells us, every banking system at any time and everywhere is the product of a deal between the politicians and the bankers, which Charlie calls the game of bank bargains. And Market Rules shows us this game in action going on and on in this country since the 1960s. And just imagine that, in fact, the game is going on all around the world in all different countries at the same time. Now, as Dick pointed out in his comments, in the decade before the book's history begins, the U.S. government and bank bargain created a banking system designed purposely to suppress competition and protect existing banks from competition from each other and from other financial companies. As Arthur Burns, writing in 1988, explained about the 1950s regime, quote, the legislation suppressed competition not only among banks but also between banks and other financial institutions, unquote. And this was in numerous ways, including, as Burns wrote, banks could offer interest on time and savings deposits, but the amount they could pay was limited by a regulation known as Reg Q. Market Rules tells us a lot about the debates over Reg Q, which meant the government fixing prices on deposits. In its day, this regulation generated views, the book tells us, which were passionate, and the regulation was considered vital by its supporters, passionate and vital. Now, I thought of having a quiz for the audience about who knew what Regulation Q was, but I decided, Bert, you're proving my point. I decided the vote would break down with 100% accuracy by age of the audience.
How old do you have to be, too?
Fairly old. In short, as the book story begins, and in Burns' words, as Burns told us, the government had restricted competitive entry and limited price and product competition, and the design, as Dick said, was to promote safety by effectively having a banking cartel run by the government as cartel manager. This made the banking system safe but sluggish. The banks of the 1950s, interestingly enough, owned more treasury bonds than they had total loans. Those of us in the trade today find that hard to imagine, but so it was. Now, the dismantling of this old-style, simpler cartel and its replacement with a government banking system structure significantly more complex and quite a bit different is the story of the book. Over the decades, as Market Rules relates, there were notable personalities involved. A few examples are worth mentioning. In the 1960s, there was then controller of the currency James Saxon, a crusader for more competition. He appeals to me a lot as a character in the story. In the 1970s and 80s, there was Walter Wriston, the most innovative banker of his day, who renamed the pompous-sounding First National City Bank of New York as Citibank for better marketing. Wriston also led the charge into the sovereign debt disaster of the 1980s. Also in the book is Hugh McCall. Mark mentioned him in the 1980s and 90s, for whom the National Bank of North Carolina became Nations Bank, and after that became the Bank of America as it is now. And McCall made Charlotte, North Carolina, a banking center on a national basis. Now, that's something that would have seemed highly unlikely when I was a trainee in the bank. In the 1990s and 2000s, for a character, I choose Robert Rubin, who was co-chairman of Goldman Sachs, the Secretary of Treasury of the United States, and then a top-level executive at Citibank, as it faltered and would, had it been left on its own, have crashed. However, largely missing from this last period, and what I think is a key key part of the story are Fannie Mae and Freddie Mac. It would have been a stronger story to include the hyper-political and huge financial role of these two so-called government-sponsored enterprises, not only their role but their size. Since Dick wants us to think about numbers, Fannie is bigger than J.P. Morgan Chase, the biggest bank in the U.S., and Freddie is bigger than Citigroup. Now I want to conclude with just a few slides. All right, Dick wanted numbers. You're an economist. I'm a financial type, so here's a slide. This lets us see the number of, this is commercial banks only from 1950s to now. We see the line goes sideways until the 1980s and then
that's
drops.
a slide in more ways than one. It looks
Yeah,
like
that is a slide.
sliding down the slide.
Down to the 4,700. Now, I don't think there's much doubt that the shape of this line will continue on down to the southeast here, and these numbers will fall. But I will say, now that's a 65% reduction in the number of banks, but 4,700 is still a lot of banks and a lot on an international basis. Over this period, while this was going on, something else also really important happened, which is that the banks became much more concentrated in real estate and real estate risk. Now, real estate is itself a highly political sector, and as banking gets more and more focused on real estate, it becomes even more political for the political and political finance. So we can say that the commercial banks, by and large, can now today more correctly be called real estate banks, and that's a huge and important story in and of itself. Whoops. All right, now we talked about how the 1950s was safe but stodgy. There were only 28 banking failures in the whole decade. This is a little history of the number of banking failures in the United States by decade. I think it's a pretty interesting story, actually. And what you see is a huge acceleration in riskiness up into the 70s, right in the period that the book is discussing, on into the 80s. Everybody probably remembers that 1,000 or so savings and loans failed in the 1980s, but on top of that, more than 1,000 commercial banks also failed. It was an utterly disastrous decade for the banks, and we saw that same decade is where the reduction in number of banks begins. Failures relative to the old days of 1950s have stayed quite high in succeeding decades. Now, here's a question. What's the optimal number of failures? What's the optimal mix of bank risk versus innovation versus the growth we want out of risk-taking? The answer to that question is nobody knows. And so the banking bargains go on. These are my last slides here. The Congress, all during this period, a little bit before the book and then during the period of the book, has been busily legislating away, proving that banking and politics is always very active. So here's the banking legislation of the 1950s and 70s. Paul mentioned the Bank Holding Company Act of 1956. There it is, along with a lot of others. There's the Interest Rate Adjustment Act of 1966, where the Congress itself got into price fixing of deposits. And now here's the decade of the 70s, a lot of legislation. And here's the decade of the 80s, another bunch of legislation. I'll just quickly point out here the Federal Deposit Insurance Corporation Improvement Act of 1991 in the middle of this, which proclaimed that it would, by instituting prompt corrective action, end bank failures and bank crises. There wouldn't be any more. Well, it was maybe a good theory, but it didn't work. Here's banking legislation in the 2000s, a lot of emergency legislation, including some things we have mentioned, and more recently in the last decade, here's more banking legislation. So I think this list, just quickly looking through it, underlines this theme which pops so clearly out of the book, that there is constant banking, politics, interaction, deal making, trying to use both sides of the deal for the advantage of both sides, and if it looks mutually advantageous, you can make a deal. And consistent with market rules, looking at this list of acts, just imagine the aggregate amount of lobbying and speechifying and
Campaign fundraising.
thank you, Paul. Campaign fundraising, good place to be for fundraising, the banking committees, and deal making that went into creating the list we've just reviewed. And thanks, Mark, for getting us to think about all these interesting things.
Thanks to both of you for some really penetrating and valuable comments. I appreciate it.
Now, as the moderator, it's my turn. So thank you all very much for your commentary. So when I read the book, and I read it all before the snowstorm, so it's a little in the spider webs a little bit, but my recollection is, I mean, and you mentioned tonight, I mean, these presidents since Kennedy, since the Kennedy years, were under the impression that unleashing, modernizing the banking system was a ticket for growth, without taxation, without anything else, that unleashing the powers of the banking system would produce prosperity. And you detail it all the way through, and it wasn't just Republicans who thought that, it was Democrats who thought that, it was bankers who played that game and went along with it. But there's also this overriding sense in your book that, markets, this notion that markets are what create prosperity is kind of oversold. That, is that not, maybe that's not really the case, and maybe we shouldn't believe that so much. So do you believe these presidents were wrong? Or do you believe that, that's missing in the book. So were they successful? I mean, they were successful in creating supermarkets. They were successful,
absolutely.
Creating supermarkets. And did it gain them, at least in some measure, the growth that they thought would be unleashed?
I don't know, because as Dick points out, I'm not able to run that series of numbers. What I tried to do was argue that these presidents, from Kennedy right through President Trump, sought to organize banking in a way to foster prosperity.
And I think you make the case well. I think the part that you come away with a little bit lacking in the end is, what do we think about that? Did it work or not work? I mean, we have the financial crisis in the end, and Dodd-Frank, somebody's trying to overturn Dodd-Frank, Jeb Hensarling at length, who is the financial crisis. Does that demonstrate that it ended badly? It doesn't seem that way.
It does not demonstrate that it ended badly. That's right. And the origins of the banking crisis are so complex. It's not Graham-Leach-Bliley, as I tried to point out. It resided all the way back in the underestimation of the risks inherent in subprime banking, the fractured regulatory system. So just to come back to some of the things the commentators were saying, if you think about Bank of America and, say, one of the large banks in Chicago, there would be two separate groups of Federal Reserve regulators, and the largest one sitting in the bank, but they wouldn't necessarily have to communicate with one another. Similarly, there were different members of the Office of the Comptroller of the Currency, but they wouldn't have to interact with one another. So you have a fractured regulatory system, an underestimation of the risks inherent in subprime banking, then the repo system.
Let's not. We don't have enough time, but
okay.
I could tell you a story about the J.P. Morgan whale case of the fracture, and maybe I will at the end. But so we come back to it. So Dick, you have a whole history of economic growth and banking and financial sector innovation. So, I mean, do you have any sense? I mean, to me, it was market forces that were pushing the banking system to consolidate, and it was political forces that were keeping that from happening. And all the legislation along the way is a grand bargain for different coalitions to get the most, or control their condition along the way. So to me, the market forces are pushing where we ended up, and the politics is making it happen in
very slowly,
steps.
Very
steps,
slowly.
yes.
Yeah. Well, I mean, on the big question of, did it really work? Was that a prosperous period for the country? I mean, I think the answer is obviously yes. I mean, if you just look at the, whether banking caused it or not, I would, I sort of say we're talking about commercial banks and savings banks here, but you have to look at the whole financial system. But the period, I was privileged to live in, I was born in 1940, and the last 6 decades of the 20th century were about as, if you look at the growth of per capita income, it's about as good as it gets. I mean, you look over 230 or 40 years of American history, those 6 decades were the best in American history. Things haven't been so great since the year 2000. But, up to then, it was really a very prosperous period. We all remember parts of it, problem. But, the story is that after World War II, the United States didn't have a lot of competition because most of whether you were our ally or our enemy, you were pretty much smashed up. And it took a couple of decades for the rest of the world to get back on its feet after World War II. So our businesses had, what everybody else wanted in that period. Our banking system was cartelized. But starting in the legislation, the commercial bankers gradually got free. But, one of their problems was that Wall Street was, cutting into their market share in finance. And so we didn't talk much about this, and you don't talk much about it. But it's an amazing thing. You should compare the balance sheets of, say, Goldman Sachs or most of these other Wall Street firms back in the 1970s with what they are today. They were small partnerships, and they all became corporations and expanded their balance sheets greatly. So that's a part of the story here, too, that you have to look at the whole banking system, not just the whole financial system, not just commercial banking. But I think, I think you're right, Paul, that the bankers wanted these, freedoms to do more, and the political system was very slow to catch up with that. And commercial banks in particular were overregulated, so that's why Wall Street took away a lot of their market share. And of course, that gave the bankers a case for saying, look what's happening to us. Wall Street is taking over.
Another point, and then we'll turn to the audience maybe for questions. During the 1980s and into the 1990s, there was kind of in my recollection of working at the Federal Reserve in the late 80s and early 90s, there was a sub-competition going on between Federal Reserve holding companies and OCC banks. And while Glass-Steagall was still in effect, there was something called a Section 20 part of the Glass-Steagall Act that allowed banks to do some underwriting of securities and investment business, and that, under Greenspan, he allowed that to expand quite a lot. So by point of fact, by the mid-90s, we really had investment banking and banking mixed in bank holding companies. The national banks wanted a piece of that, and I think you might have covered that a little bit. But the laws were forced, essentially, at some point to catch up with that. They at some level, the Federal Reserve, through the back door, was pushing a liberalization that finally got cauterized in the Gramm-Leach-Bliley in 1999, and I'm not sure that I'm not sure I picked up on that totally, but
I thought I covered that.
Did you?
Not
okay.
as articulately as you just did. Especially you have superior knowledge of Section 20, but I disagree with some of what you're saying here about banks catching up, laws catching up with markets. The ability to discern the market's sovereign judgment is very difficult. And bankers disagreed right through early 1999 about Gramm-Leach-Bliley, especially the smaller bankers.
They did fight
and
over
the insurance
details.
companies, and before that, the securities dealers.
That's covered well. But the forces to reunite investment banking and commercial banking were taking place from the late 80s,
absolutely,
all the way up to the and that was happening without legislation, and it was, in a sense, pushing politicians kind of to the inevitable that they had to deal with.
It took place through regulators. That's right.
Regulators are, and it comes across in many points in your book that unelected regulators behind the scenes.
That's right.
Just like today, are so important in interpreting the laws on the books and allowing financial innovation before the Congress gets to issues that it may or may not address.
Not just allowing, encouraging, and directing.
Absolutely. So with that, why don't we turn it over to the audience and take some Q&A. So why don't I start here and then go to Bert right here in front. Please tell us your name and then ask your question, and keep it short if you could.
Okay. My name is Mark Tunney with Mathematical Finance Company, and I work with the American Academy of Actuaries Committee that does risk calibration for their risk model. And this group has started a project to get the calibration data for bank and insurance and derivative dealers' risk models made public on a regular basis, like monthly, not just in the U.S. and other countries. And Christine Lagarde, the head of the IMF, supports the project. And we've talked to Brian Moyer, the director of Bureau of Economic Analysis. My impression is we're going to have the most trouble getting the banks to cooperate.
So what's your question?
Well, you've talked about the politics of this. Well, what do you think of the politics of getting the calibration data for bank and insurance and derivative dealer risk models made public?
Sounds like a great idea.
But who's going to resist it, and how do I get this to happen?
Sounds like a hard project to me politically. One of my favorite lines in the book is how all of the banks and the savings banks thought the most horrifying prospect as the 1990s went along was that an insurance company might own a savings and loan, and that would really be awful. And as I read it, I imagine my nice account I have with State Farm Bank, which actually used State Farm as the, if State Farm Insurance Company owned a savings and loan, wouldn't that be really horrible? And there is now State Farm Bank, and it's not so horrible. They treat my account pretty well. So I think the industry politics of what you're talking about sound hard to me. I wish you good luck.
Okay,
Bert.
Thank you, Bert Ely, a banking consultant. Just a quick observation and a question. I haven't heard any discussion about the impact of electronic technology on how it's affected the banking industry. Does the book get into that? It would seem to me that would be a significant factor. But here's my question. Okay, we've seen this evolution of banking over the last several decades. We are where we are today. What do you do about it? Is there a need for fixes? Is there a need for significant change in the legislation or the regulation of banks? How is all this supposed to evolve from where we are today?
So you have two great questions. Yes, I talk about computers in the sense of, for example, Walter Wriston purchased computers and then leased them to companies who needed some computer space. So the question was, did that constitute a legally made loan for a regulated commercial bank? So that fell within the purview of regulation and legislation. Ultimately, it was answered, yes, that they can do that. I don't have an answer about what we need in the future. As these gentlemen were pointing out, we have a heck of a lot of bank legislation out there, and the phrase I use in the book is the endlessness of it all. It never stops.
So, Bert, the answer is as long as we have banks and politicians, we'll have more legislation.
Well said.
Well, as long as they're all run by human beings, Bert, there'll be more politics and more legislation. But the key is, will, on average, economic growth continue? And it will continue if, on average, there is more innovation, there is risk-taking, there is competition, and there is the rule of law. But at the same time, that's on average, and every now and then, since these are all the government agencies, the banks themselves, not to mention all the rest of society, are composed of human beings with all their foibles, their hypocrisy, their fears, their self-delusion, as well as their good ideas and their drive and their energy. From time to time, we're going to have crashes and mess-ups. But the question is, on average, do we keep going up? And my answer to that is yes.
I think, if I could weigh in on Bert's question, that the technology is subject to economies of scale. So the bigger banks can afford the technology more and probably benefit more from it, and that's going to continue. So I think it's an important point you're raising. And to me, it suggests that what the future is for, even though we've seen the banks fall from, 30,000 98 years ago to 5,000 now, we're probably going to have even smaller numbers. I mean, the trend is for that number to get smaller. That doesn't mean, I think what's going on now, I used to think, the number of banks is going down, but the number of branches is going up. But today, I think the number of branches is actually going down as well, and that's because, I paid a few bills this morning before I got on the plane to come down here from snowy New Hampshire, I didn't have to go to the bank.
Your iPhone.
The bankers will tell you your phone
that's right.
is the next. Is the
I mean,
next
we
branch.
all have a supercomputer in our pocket now that can do all kinds of things for us.
Bert, if you just push on the electronic idea, we'll all know one of the questions is, how far can artificial intelligence go? So I would like to propose that suppose there really is true intelligence embedded in electronic machines. Will that intelligence do better at avoiding mistakes and politics and periodic busts and crashes than natural human intelligence? And my answer is no, it will not. That it's inherent to the problem of intelligence, which is the unknowability of the future. And what we're struggling through is dealing with that uncertainty and unknowability, whether it's machines or people. And also because of that, we're going to keep having political attempts to make the uncertain more certain, but they will never succeed. And therefore, as Mark says, this game will go on forever.
Take a question. How about back there first, and we'll come up here again.
Mike Webb. I was graduating from college around the growth of super regionals and ATMs popping up and all that kind of thing. But I was at a conference last week. They were talking about startups and things like that. In terms of technology startups, they seem to be popping up in the same places where the super regionals suddenly sprung up: Charlotte, Atlanta, Nashville. And I'm wondering, is there anything outside of the banking finance community that causes that kind of thing to happen? It's the same places where these things are popping up.
You mean community banking arising right next to the...
I think he means fintechs.
I think
He means
fintech.
fintech.
Fintech. I've written a little bit about fintech. It's my impression that, some people say fintech is a big competitive challenge to banking. My guess is the banks themselves, the established banks, especially the bigger ones, will, they're already doing it, I think, but they're going to, incorporate fintech into their models, and they probably. So I don't view fintech as so much a challenge to the current structure of banks, but the big banks will, as a part of the technological revolution, will incorporate fintech into their models.
It's an interesting question. I decided not to take up fintech. I was becoming aware of their development as I was completing the book, and I didn't want to push on into a new area. But it shouldn't be surprising to any of us that the cities in which these firms are appearing are the larger, more prosperous cities that are drawing in recent college graduates, people with MA degrees, major universities.
Up here, please.
Gerald Chandler. It seems to me that you were talking about banks and that you did not include savings and loans and credit unions and even ATMs. Mm-hmm. So when we have this chart of what happened to banks, it would have been more interesting or more inclusive to me to say what was the total of banks, savings and loans, credit unions, and so on. And so the question is, am I right that you didn't include them?
Yeah, they weren't in our numbers, but I can tell you what the numbers are. In 1950, the sum of savings and loans and banks was something over 19,000 institutions. That sum is now down to about 5,400 or so. So the decline is even steeper if you include the savings banks.
The fundamental question underlying the book is, around 1960, there were savings and loans, investment banks, commercial banks, small insurance brokerage outfits. And by the late 1990s, there were these, what I called supermarket banks. And so the question was, how did that transformation take place? But no, I did not specify the number of savings and loans, and perhaps I should have. And credit unions, right.
I think we had some savings and loans in some of our numbers, but not credit unions.
Similar credit unions, similar reduction. There were all very large number of credit unions. All the U.S., if you add it all together, with half the population of today, had, 6 or 8 times as many financial institutions. So that we see, if you think about it on a per capita basis, a huge shrinkage. But in sum, they're all bigger. The sum total of banking assets relative to GDP, to the size of the economy, is bigger than it was, even though the number of institutions is smaller.
Thank you. I'll take advantage of the remarkable historical perspective that you all have and let any of you who want to answer this question take it. Doctor Who, the British TV character who brought the time-traveling machine, the TARDIS, to the use of mankind, has made it available to you. And you can go back, each of you can go back to 2002 with an appointment as the Federal Reserve Chairman, and you're really respected, so you've got cred. What's the one thing you would do to prevent the 2008 Great Recession?
Well, that assumes the Federal Reserve can do that.
One of the major mistakes I think they made early on was in not recognizing special purpose entities that they allowed to go off balance sheet. The regulators debated the regulatory treatment of these, the capital treatment of these, and they never settled it, and they kind of forgot about it. And all those assets that were highly risky and finally blew up, many of them ended up situated in special purpose entities, which there were hundreds of them. Many banks had them. Nobody was looking at what was in them. They should have been. I think that was one of the single biggest mistakes because nobody saw the problems that we're building or worried about it. And it wasn't like we didn't see it earlier. Back in the late 1999, around 1999, in the finance company industry, a number of finance companies had made a lot of loans on what they call manufactured housing, which is a fancy name for mobile homes. There's a particular outfit, Conseco, and a few other ones. And they packaged, the way they funded themselves was they packaged up their mobile home loans into structured bonds, senior, and sold them off to the market. And when that bubble blew up, it blew up because at the time in 1999, they had nobody to sell the equity loss piece, the riskiest piece to anybody, because nobody believed the accounting and there was nobody. So they kept it on balance sheet and they valued them very highly. And an auditor went in and basically brought them to truth and had to write down their equity piece, and they were bankrupt and they blew up and that whole market fell apart. But it wasn't part of the banking system, and regulators didn't learn anything from it. Subsequently, a few years later, Enron had some of the same problems with off-balance sheet repos, what would they call them, Repo 360, where they did repurchase agreements that were just under the wire, so they had all kinds of fancy ways to raise really hot money, really risky, without anybody really knowing it. Enron blew up. But it wasn't in the banking system, so the banking regulators never learned their lesson from that, and those things ended up biting them and causing the financial crisis.
Great point. And subprime auto, exactly the same story in the same way. But my answer would be different. Don't drop interest rates if you're the Fed in those 2002, 3, 4, in order to create a housing boom to offset the mild depression.
Compounded it.
That made it worse. And the other thing, I would say Paul is absolutely right in what he says, but you could state it more generally, which is look for high leverage based on exaggerated prices of assets. Mm-hmm. That's what's the same about all those cases. And it was the same about housing. So if you'd only been smart enough, which hardly anybody was, you'd have tried to see what happens to highly leveraged structures if the prices of the underlying assets drop dramatically.
Can I make a comment on that? I mean,
of course you can.
One of the points that Alex made was that banking has become like real estate banking now. Like what, half of the lending is on...
Half of all the loans.
Half of all loans are commercial or residential real estate loans. Now, and that wasn't true, especially in commercial banking 50 or 60 years ago. But one of the things you learn when you study banking history, and I think Walter Bagehot said it, Bagehot's Rules, the English editor of The Economist, who wrote, banks should be lenders of last resort and so on. He said, if you want to be a banker, you need to know one important thing, the difference between a promissory note and a mortgage. Your business deals with the former. And so classical banking theory says that, commercial banks should not be involved in real estate. Alex Pollock says, they're heavily involved in real estate now. In colonial America, they had land banks, and we rejected the idea because the land banks had the same trouble. What happens when the property values fall? We got into trouble in 2002 or 3 that you were talking about because on Wall Street, and the guys that were taking all these mortgages and packaging them into mortgage-backed securities said, well, we're perfectly safe now because real estate prices never go down. And so, if we lend money to this guy who just swam the Rio Grande from Mexico and he gets to buy a $400,000 house in America, there's no risk there because if he doesn't pay his mortgage, we'll just, take over the house. I mean, that's the kind of thinking that was going on. And, anybody who knows any economic or financial history knows that real estate, there have been bubbles forever in real estate. And so I would say that maybe the danger in our system today is that we're too much involved in, banks are too much involved in real estate.
I think we'll close it in just a second, but one final thought. While all my smart panelists and myself may have, with hindsight, perfect 20/20 hindsight, decided exactly how we would have stopped the last financial crisis, you have to remember, if there are no losses, the politics of the day is not going to let the regulator shut anything down.
Oh, there was the young lady there who had her hand up throughout the question. Could she ask the last question?
Of course she can.
Thank you. Nancy Spanos. I just wrote a book called Hamilton. Nancy Spanos. I just wrote a book called Hamilton versus Wall Street, so you know my outlook. But what I wanted to raise, I haven't unfortunately read the book, but I know that there was, at the time of Dodd-Frank coming through, there was also a move to reinstate Glass-Steagall. There was legislation in the Senate, Maria Cantwell, et.cetera., and following that there was legislation in the House for the next several years that got over 100 supporters. And the argument that was made was popular like Henserling. This was, when Glass-Steagall was there was the golden age of productivity in the United States. The 30s to the 50 period, which you referenced, was the period where economists indicate productivity was at its height. Now, I wonder what you, how you would reflect on that.
Let me pick up two questions.
We only have a second, Mark, so you have to be really quick.
Yes, that legislation was in the House and Senate. It was not backed by the administration. They were interested, as I argue in the book, in promoting and perpetuating the supermarket banks. They were not interested in breaking banks apart, and the economic disruption they judged would follow.
So that'll have to be the last word. I'm afraid we're out of time. I'd like to thank my guest author, Mark Rose, and the distinguished panelists for their commentary. Thank you very much. You can chat with them and